provide young investors with access to diversified portfolios at a relatively low cost. The question is, what are the key advantages of professional management for these investors? Sometimes you need a guide. What would you say?
Yeah, I agree. You're completely right, because see, when you give money, hard-earned money to a mutual fund, there is a fund manager who has experience, who has resources at his hand, and plus a lot of knowledge with which he will be managing your money. So, vis-a-vis an individual investor who may not have that kind of time, expertise, and knowledge to do that. So definitely, mutual funds there become a preferred choice. Also, mutual funds, based on their experience, have understood risk management, and that is the reason, if you see, there are mutual funds which are diversified across market cap. There are mutual funds which give exposure to different sectors, and finally, uh, it could be even diversification among different asset classes. In addition to that, a young investor who has just started earning, he is going through challenges at his job. There could be challenges, or demand for his time, or his or her time in his personal life. So he may not have enough time to monitor the markets, to monitor the investment, and this is where the mutual funds take up all the burden. And this burden is taken at such a small cost that I don't think any young investor would mind paying for, given the time and effort the mutual fund puts in managing her money. On
Absolutely, and
top
that's
of
what the
it,
expense ratio is. Also, it clearly shows what is the cut sort of going to the mutual fund expert who is managing your money. So, go ahead, Milan. You had some points to add there.
yeah, and one final point here is the discipline aspect, which mutual fund bring in through the process called SIP. Otherwise it's very difficult even for a senior person to be so disciplined that invest one portion of his monthly income, his or her monthly income every month, in an SIP. So in essence, this also brings in discipline. And we come across so many young investors who've just started earning, and they, from the first salary itself, they've started their SIP.
So it's great to hear that young investors have started journey early, and as you mentioned, SIP brings in that discipline where a part of your paycheck is going towards securing your future and maybe opening up new opportunities. Especially as sometimes folks, they think about fire, financial income, retire early. So maybe your money is going towards making sure you do what you want to do. Retirement doesn't mean you don't work; it just means you work where you want to. So the idea is, once you get into that discipline, a lot of opportunities open up. All right, let's discuss some nuances in this, and let me bring in Deepak for his perspective, because Deepak, from the options, the universe of options which are available currently, right? The thought also, especially for young investors who want to know more, where they say, index funds is fine, but there are so many growth opportunities when it comes to sectors or themes. Maybe I want, as part of my diversification, some investment on that side. So your thoughts, Deepak, on how young earners can capitalize on growth opportunities in, say, specific sectors such as technology or defense or healthcare or renewable energy through sector specific mutual funds. Your thoughts on this, Deepak?
All right. So when I look at India's growth story, and I'll jump straight into it, I see that we are sitting on top of a very rich demographic dividend. And there are two major enablers to this demographic dividend really playing itself out in the next 10, 20, or 30 years. And the first element is very naturally the fact that, from the last 10 odd years, we've been on a Make in India drive within our country. So the beneficiary of this is the specialty manufacturing theme. When I look at it in terms of sectors like healthcare, in terms of both drugs and equipment, semiconductor and technology products, chemicals and batteries, defense and aerospace, these are some of the themes that the government has to a degree pushed ahead by linking them to production linked incentives, which effectively implies that to a degree the government is providing the tailwinds these sectors need to do the right amount of capex and grow from being fairly small sectors in India today to capturing a bigger share of the global pie. So I think these, when you are talking about in terms of specific sectors, these are growth sectors for India, and they are growth sectors not just because we have the capability to manufacture these, but the capex is being encouraged by the government through this PLI scheme. So that's one part of this growth engine when I look at how India is going to do in the next couple of decades. When I look at the second element of that growth engine, I also see how our consumption is changing. So as we are climbing up the GDP ladder, as our disposable incomes are rising, as our per capita unadjusted income is climbing from $2,000 in the last few years, now slowly inching up towards $3,000, it has a exponential impact on how we consume things and what we consume as a country. And this rising, let's say, per capita income will leave households with more disposable income, which will create a demand for a whole suite of products with higher value added elements, which also implies that country or companies, in fact, which are focusing on the Indian consumption story, are at a precipice of growth. That as the per capita income grows, the need for value added or to a degree enriched product grows. So to a degree, the ability to command some premium and provide a more, let's say, enriched product offering to the end consumer grows. And this basically means that whether we are looking at some of these high growth PLI driven sectors with a government push, or the broader market with some of the more classic sectors like your energy, like your consumption theme, we are looking at the growth now slowly starting to trickle into this with the GDP changing and with the incomes evolving. So I think there are various sectors that young investors can consider. These sectors can be a function of their own job. For example, if one of you is employed in technology, you might want to consider taking exposure to other sectors outside of technology to kind of hedge yourself or diversify. Because assuming that technology is growing, and it's a very safe assumption to have, but it's still an assumption, having exposure outside your core work sector can also diversify your overall financial well-being. Like if the sector does well, you naturally do well being employed in that sector, but taking exposures outside that sector, in particular, maybe adding some of these high growth themes to your portfolio can enable you to get there faster.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।